So, have you ever wondered how a group of unelected officials out somewhere in Washington, how they can control the entire economy? Because that's what the Federal Reserve does, or at least they try to do. They influence mortgage rates, credit card interest, the stock market, and your 401k, even the value of your savings. And this is the kicker. This system, it's worked for decades, but it's in the middle of changing. So today we're breaking down how the Fed controls the economy and why it's starting to lose that control in a sense. So the Federal Reserve, it has this job, and the job is to keep the economy stable. And what that means is it wants things like low inflation, they want high employment, they want this functioning financial system that's in, say, a balance. It's like a teeter-totter, and they want that sucker leveled out. And to do that, they have what's called their monetary policy. And think of this as their tools they have in their toolbox. So they got things like open market operations. This controls the money supply through, let's say, buying and selling government debt securities. And then they got reserve requirements. This is more so for the banks and how much money they have to have on hold or in reserve. And this influences lending. And then they have their speeches. And within their speeches, they have forward guidance. This gives us insight into what the Fed's plan is, their tone, their projections. Is it hawkish? Is it dovish? So, and then of course they got interest rates. This is probably the largest of their tools that they have. So, lower rates, that means cheaper borrowing, more spending. Sometimes stocks go up on that. And if they raise rates, that's seen more as tightening. This is more hawkish on the economy. It's more restrictive. That means higher rates, meaning more expensive credit, less spending, inflation down. So, in really simple terms, the Fed is, it's like they're messing with this thermostat for the economy. So if the economy is running too hot, you just turn up the rates. If it's too cold, well, you cut them down. And this is where there's this problem. Every time they touch this thermostat, it's kind of like breaking down, just wear and tear. The switch doesn't work as good. So let's talk about that. So for decades, that tool has worked for the Fed, all of their tools, but the system they're built on it's really changed. It's not the same. It doesn't exist completely how it always had. Because back then, like back in my day, higher productivity, there was lower debt, there's more room for maneuverments in the economy. Maneuverments. And if you're looking more so in the current of today, the US is completely drowning in debt on screen. If I could pull it up real quick fast for you. This is the government debt clock. And what this is showing is the US is drowning in debt. You see that the US national debt, it's at 38 trillion and counting. It's still climbing. So when the Fed raises rates to fight inflation, it makes the government's own debt more expensive because like you and I, like, yeah, I gotta go buy a car, you gotta go buy a house, whatever you're buying on credit. Like, yeah, we pay like the amount we borrowed plus interest. Well, so does businesses and so does the government. So in super simple terms, if let's say I borrow $100 from you, I gotta pay you $100 back plus interest, and you're charging me 3% interest because you're a good friend. I owe you $103 back. So for borrowing money, it costed $3. So I gotta pay you the money I borrowed plus interest. So that's $3. Super simple. But imagine if it was $6 now because it's 6%. But let's imagine we're borrowing a lot more money because we're like a government. And that's more so in the trillions. But for clean numbers, let's just use 1 trillion at 6%. That's $60 billion. 60 billion with a B. $60 billion. And we're not paying off principal yet. This is just interest. So you still owe the 1 trillion back, but you also got to pay $60 billion for borrowing that trillion. So that's kind of the tweaks with it, the nuances, if you will. Now, apply that to the entire government that's running at a growing deficit each and every single year. Yeah, they're trying to help that, but that's the cycle. It's a trap. And you raise rates in the Fed's point of view, you crush borrowers, you cut rates, you reignite inflation, and if you do nothing, you risk market panic. Either it goes euphoric to a point that it causes panic then, or it just like jumps off the cliff and goes into panic. It's like taping over this leak you got in the ceiling or whatnot, and like it's a temporary fix, but we all know like there's pressure building there, like that didn't solve the problem. It's just a quick fix. And I'm sure we haven't seen the end of that problem. So rates aren't the Fed's only lever. They also control liquidity in markets, how much cash is moving around through the system. They do this through their open market operations. And more specifically in these terms, what I'm talking about is QE and QT, quantitative easing and quantitative tightening. So QE, this would be like digital money printing on the balance sheet. They just changed the number. They created money out of thin air. And then QT, quantitative tightening, that's letting debt roll off and shrink off of their BS. They're just done with it. Their balance sheet. And QE kind of in a way means the Fed buys bonds, and through buying the bonds, it provides cash to banks. So it's pumping money into the system, and money's moving around, which is good. And that's why we seen stocks really explode during the pandemic from all of the money just floating around out there. And when QT happens, think about how the Fed stops reinvesting. It pulls cash out like a vacuum cleaner, and markets begin drying up. And in a way, that's I don't know. You could argue it's happening right now, but with stocks just going straight up, I don't know that you could argue that. And what everybody's watching right now is the Fed's BS, the Fed's balance sheet. They're watching this thing like a stock ticker. They're watching it like it's the price of Bitcoin. And here's the real issue. The Fed's tools don't work like they used to. They're constantly changing the impacts. The market's trying to outsmart literally everybody. Everybody's trying to outsmart everybody, predict, guess, jump ahead and price in all of these moving pieces even before they happen. And what the Fed can do is, yeah, they could print money, but they can't print productivity. They can't produce more goods and services. They could cut rates, but they can't create more energy or workers. So every move now, in this case, when you're looking at it through this set of lens, it comes with side effects. There's no like riskless path. You cut too soon in terms of interest rates, inflation returns because people's inflation expectations change. You cut too late. You keep rates high too long. Unemployment begins to spike. And let's say you shrink this balance sheet too fast. Well, liquidity crisis, and the economy we're in now, it reacts with a lag, with a distortion differently. Like it reacts in ways that just don't make sense sometimes, and even sometimes in pain. And when you think about it, like look at this. You remember 2022, the inflation spike we seen there? Look at that. Just straight up. Boom. Well, now in 2025, we're watching a weakening job market, which we're not getting the data right now. The last BLS report we got was back in September. But September for August's numbers, but we're seeing layoffs from Amazon newly announcing layoffs, UPS, Rivian, Paycom, all these different companies, and not even to mention all the small companies that are really struggling right now from rates and how certain consumers are doing. But this is all stuff the Fed is watching. And the Fed, they've already vocalized, they've already straight up said that they're more worried about the labor market rather than risks of inflation. And that's why they're floating this quarter point rate cut this week, as early as tomorrow. Tomorrow's the FOMC's interest rate decision. And here's what nobody wants to say out loud. The Fed's powers relies on confidence, not just its tools. So yeah, the Fed can go out and cut rates tomorrow 25 basis points or 0.25% off of the Fed funds rate. But what's their tone look like? Do they seem to have everything under control? What are they forecasting? And if it doesn't come off as credible or believable or under their own independence and not influence of external parties like the US government, if markets stop believing the Fed can manage the chaos, that's when the chaos begins to take over. From trade wars to record debt to geopolitical shocks, every single time Powell speaks, trillions of dollars hang on to every single word to scan and observe what is being said both out loud, in between the lines, and like symbolically out of all of that. It's not just about monetary policy anymore. It's about more so like human psychology, monetary psychology at this point. So, how does the Fed control the economy in this case? Well, they do so by setting the cost of money and managing its flow, but why is that system failing now? It's because money alone doesn't fix the problem. Productivity, energy, supply of workers, trade, structural issues, all of those factors are also at play here, all simultaneously. So, as the Fed eyes yet another cut tomorrow, we're left with one big question. Is the Fed still steering the economy, or is it reacting?